Hello everyone and welcome back to the channel. Whether you're a seasoned investor or just curious about how it all works, you're going to want to stick around for this. We've got some real surprises in store that will change the way you look at Wall Street forever. Before we jump in, if you enjoy content like this and want to learn more about the world of finance and investing, do me a huge favor and hit that like button, subscribe to the channel, and ring that notification bell so you never miss an update. Your support means the world to us and helps us create more content just for you. Alright, are you ready? Fact number 1. The New York Stock Exchange, or NES, wasn't always indoors. That's right. It all started back in 1792 under a buttonwood tree on Wall Street. A group of 24 stockbrokers signed the Buttonwood Agreement, which established the rules for trading securities. It's incredible to think that the world's largest stock exchange had such humble, open-air beginnings. They eventually moved indoors, first to a rented room, and then to the iconic building we know today. But it all started with a handshake under a tree. Moving on to fact number 2. The terms bull and bear market, which describe upward and downward market trends, have some pretty interesting origin stories. While no one is 100% certain, the most popular theory relates to how these animals attack. A bull thrusts its horns up into the air, symbolizing a rising market. Another theory traces it back to the days of bearskin jobbers in London. Who would sell bearskins? They hadn't yet received essentially betting that the price would fall. Either way, these animal terms have become a fundamental part of Wall Street jargon. Fact number 3 might surprise you. The longest bull market in U.S. history lasted for nearly 11 years. It started in March 2009, right after the Great Recession, and ran all the way until February 2020, during this incredible run. Showing just how resilient and powerful the market can be over the long term. It's a great reminder that even after major downturns, the market has historically always recovered and reached new highs. Now for fact number 4, and it's a big one. The U.S. stock market is the largest in the world by a huge margin. As of recent data, the total market capitalization of publicly traded U.S. companies is over $50 trillion. A significant portion of the world's wealth is tied up right here. On May 6, 2010, the Dow Jones Industrial Average plunged nearly 1,000 points, about 9% just a matter of minutes, only to recover most of that loss just as quickly. For a while, no one could explain what caused this terrifyingly fast drop. It was later attributed to a perfect storm of automated high-frequency trading algorithms reacting to a large sell order. Fact number 6 is about dividends. Did you know that some companies have been paying dividends to their shareholders for over 100 years, without interruption? These companies are often called dividend kings or dividend aristocrats. For example, companies like Procter & Gamble and Colgate-Palmolive have paid and increased their dividends for over 60 consecutive years. This demonstrates a company's financial stability and commitment to returning value to its shareholders, making them very attractive for long-term income-focused investors. Here is a fun one for fact number 7. The first ever publicly traded company in the world was UNT, American, but Dutch. It was the Dutch East India Company, which issued shares on the Amsterdam Stock Exchange in 1602. However, the first publicly traded company on an American exchange was the Bank of North America, which went public in 1781. This laid the groundwork for the corporate structure we know today, where anyone can own a piece of a business. It was a revolutionary idea that democratized investment and fueled economic expansion. Fact number 8 delves into psychology. The stock market is heavily influenced by human emotion. The fields of behavioral finance study how psychological biases affect investors. Fear and greed are the two most powerful drivers. Fear can cause panic selling during a downturn, while greed can lead to irrational buying during a bubble. Understanding these emotional biases is crucial for making rational investment decisions. Let's look at the January effect for fact number 9. There are a few proposed reasons for this. One is that investors use their year-end cash bonuses to buy stocks. Another is that people sell stocks in December for tax loss harvesting and then buy them back in January, pushing prices up. While this anomaly has been less consistent in recent years, it's a fascinating example of the seasonal patterns that traders and analysts look for in the market. And finally, fact number 10. Over the long run, the stock market has consistently gone up. Despite all the crashes, corrections, and bear markets throughout history from the Great Depression to the 2008 financial crisis, the overall trend has always been upward. For example, the S&P 500 has delivered an average annual return of around 10% over the past several decades. This is perhaps the most important fact for any long-term investor. It highlights the power of patience and staying invested, rather than trying to time the market's short-term movements. The key is time in the market, not timing the market. So there you have it, 10 facts about the U.S. stock market that hopefully gave you some new insights into the complex and incredible world of finance. The stock market's history is filled with fascinating stories and important lessons. It's a system driven by innovation, economics, and human psychology all at once. I hope you found this interesting, and maybe even learned something you can apply to your own financial journey. Thank you so much for watching. If you enjoyed the video, please don't forget to give it a thumbs up and subscribe for more content.